In 1895, Alfred Nobel signed a will that defined the future of human intellect. He chose physics, chemistry, and medicine. Sciences governed by absolute, unbreakable laws. Gravity doesn't lie, chemicals don't have hidden agendas. But economics was left out in the cold. It was too messy, too human, too unscientific. In 1968, the Swedish central bank, Sveriges Riksbank, decided to buy economics a seat at the big kids' table. They established the Prize in Economic Sciences in memory of Alfred Nobel. Notice the wording in economic sciences. It was a deliberate attempt to dress up the study of money in the lab coat of a physicist. They wanted to believe that markets were efficient machines, as predictable as the planetary orbits. For decades, this worked. The prize often went to men who built elegant mathematical models of a perfect world. But in 2001, the committee did something radical. They handed the gold medal to three men, George Akerlof, Michael Spence, and Joseph Stiglitz, who looked at those perfect models and said, "This is fantasy." They didn't win for discovering a new law of order. They won for discovering the chaos of secrecy. They proved that the one thing distinguishing economics from physics is that atoms don't keep secrets from each other, but humans do. George Akerlof, Michael Spence, and Joseph Stiglitz. These three men were awarded the Nobel Prize for analyzing markets with asymmetric information. That sounds dry, doesn't it? Academic jargon designed to put you to sleep. But strip away the fancy words and you find a terrifying revelation. For 2 centuries, economists worshiped the invisible hand, the idea that free markets always find the right price and the right balance. But Akerlof and his colleagues proved that the invisible hand has a fatal weakness. It goes paralyzed when it's blind. They showed that when one person in a transaction knows something the other doesn't, whether it's a used car salesman, an insurance broker, or a corporate CEO, the market doesn't just get inefficient, it can completely disappear. It stops existing. To understand how a simple secret can destroy an entire economy, we need to answer 3 massive questions in this video. Question 1. What was the beautiful lie that economists believed for 200 years before these 3 arrived? Question 2. How does a beat-up used car, a lemon, prove that capitalism is inherently fragile? Question 3. From health insurance to the 2008 crash, are we currently trapped inside a global market of secrets? Let's go back to the beginning, to the world where everyone told the truth. For a long time, economists lived in a fantasy land. In this land, ruled by the theories of Adam Smith and Walras, the market was a place of total transparency. They called it the assumption of perfect information. The idea was simple and seductive. In a free market, everyone knows everything. If you walk into a store to buy an apple, you know exactly how crisp it is. The seller knows exactly how much it costs to grow. Because we both know the truth, we can agree on a fair price. The invisible hand works its magic and resources are allocated perfectly. This wasn't just a lazy guess, it was a necessary simplification. Just like physicists assume a vacuum to calculate gravity without air resistance, economists assumed a world without secrets to calculate prices. And to be fair, in this theoretical utopia, no one gets cheated. If a seller tries to sell a rotten apple, the buyer, who has perfect information, sees it immediately and refuses to pay. Bad products are naturally weeded out. Prices reflect true value. It is a beautiful, self-correcting machine where fraud is impossible because ignorance does not exist. It was a comforting worldview. It told us that if the government just stayed out of the way, the market would naturally protect us. But George Akerlof looked at this beautiful model and asked a question that shattered the glass house. Have these economists ever tried to buy a used car? But in the late 1960s, a few economists started noticing a glitch in the matrix. They looked at the real world and saw something that shouldn't exist in a perfect market: missing markets. According to the old theories, if people want to buy health insurance and companies want to sell it, a price should appear and a deal should be made. Supply meets demand. Simple. But in reality, insurance companies were refusing to sell to the elderly. Banks were refusing to lend to small businesses, even at high interest rates. The invisible hand was paralyzed. Why? The anomaly was hidden information. The beautiful theory assumed the buyer and seller were looking at the same object, but they weren't. In the real world, the seller knows if the house has termites. The applicant knows if they are lazy. The borrower knows if they plan to run away with the money. The buyer, the employer, and the bank, they are blind. This wasn't just a small friction, it was a fundamental system failure. When one side holds all the cards, the price mechanism breaks. A low price doesn't mean a good deal. It might mean a trap. A high price doesn't mean quality. It might just be a bluff. Economists were stuck. They couldn't explain why markets collapsed without blaming irrational human behavior. They needed a new code to decipher the chaos. And that is when George Akerlof walked in with a paper about, of all things, bad used cars. In 1970, George Akerlof tried to publish a mere 13-page paper. 3 major journals rejected it. One editor told him, if this were true, economics would be wrong. Well, economics was wrong. Akerlof introduced a concept that would later win him the Nobel Prize: adverse selection. Here's the mechanism. Imagine a market for used cars. There are good cars, peaches, and bad cars, lemons. The seller knows which is which. The buyer does not. In the old world, the price would average out. But Akerlof argued that because the buyer can't tell the difference, they are terrified of getting a lemon. So they refuse to pay a high price for any car. They offer a low average price to protect themselves. Now watch the dominoes fall. If you are the owner of a peach, a truly great car, you look at that low offer and say, no way, my car is worth more than that. So you walk away. You leave the market. Who is left? Only the sellers of lemons. They are happy to take the low offer because their cars are junk anyway. Suddenly, the market is flooded with junk. Buyers realize this and drop their offers even lower. More decent cars leave. The cycle repeats until there are no good cars left, no buyers left, and no trade at all. Akerlof proved that asymmetric information doesn't just make prices unfair, it drives quality out of existence. It is a death spiral initiated by a single secret. If the car example feels distant, let's look at something we all understand: lunch. Imagine a restaurant opening a new all-you-can-eat buffet. The owner does the math. He figures the average person eats $15 worth of food, so he sets the ticket price at $20. He expects a nice $5 profit per head. In a world of perfect information, the owner would scan your stomach at the door. He would charge the light eater $10 and the heavy eater $50. Everyone is happy. The market works. But in the real world, the owner is blind. He sets one flat price, $20 for everyone. Now watch the logic of Akerlof kick in. The light eaters, who only want a salad worth $5, look at the $20 price tag and think, what a ripoff. I'm subsidizing the gluttons. So they leave. They don't buy a ticket. Who stays? The heavy eaters. The guys who plan to eat $50 worth of steak. To them, $20 is the deal of the century. The next day, the owner counts the cash. He's shocked. He lost money because only the hungry people showed up. Panic sets in. To cover his losses, he raises the price to $40. This is the fatal mistake. At $40, the medium eaters now feel cheated. They leave too. Now the only people left in the restaurant are the absolute fiercest gluttons who can eat $100 worth of food. The restaurant goes bankrupt by dinner time. This is exactly what happens in health insurance. If an insurer can't distinguish between the healthy and the sick, they charge an average price. The healthy young people leave because it's too expensive, leaving only the sick elderly in the pool. Costs skyrocket, premiums explode, the market dies, the buffet is closed, not because there was no food, but because there was no truth. To see the wreckage of asymmetric information, we don't need to look at used cars. We need to look at the graves of the 19th century life insurance industry. In the mid-1800s, selling life insurance was considered a suicidal business model. It was a gamble that nearly every company lost. Here was the scene. An insurance agent would set up shop in London. He would offer a policy, pay us £1 a month, and we'll pay your widow £500 when you die. It sounded fair. The actuaries had calculated the average death rate. The math was perfect. But they missed one variable. That's the secret. The only people who rushed to buy these policies were those who knew something the insurance agent didn't. They knew they had a persistent cough. They knew their chest felt tight. They knew they were dying. The healthy people? They looked at the price and said, I feel fine, why waste money? So the insurance pool became a club for the terminally ill. One by one, the policy holders died immediately after signing the contract. Claims flooded in. The cash reserves drained away. Company after company declared bankruptcy. The entire industry was on the brink of extinction. Capital was being destroyed at an alarming rate. They were playing poker against opponents who could see through the cards, and they didn't even realize it. The industry had two choices: die or evolve. They chose evolution. The survival strategy relied on two new weapons that Joseph Stiglitz and Michael Spence would later mathematically perfect: screening and signaling. First came the screen. Insurance companies realized they couldn't just ask, "Are you healthy?" because liars would say yes. So they stopped asking and started testing. They mandated medical exams. They forced applicants to jump through hoops. This was Stiglitz's screening, setting up hurdles that only the healthy could clear. But the real struggle was psychological. The healthy people, the good customers, were still leaving. They needed a way to differentiate themselves from the dying. They needed a signal. In a brilliant twist, the companies introduced waiting periods and deductibles. Think about it. Who is willing to sign a contract that says, if you die in the next 6 months, we pay nothing? Only a healthy person who expects to live a long time. A dying man wouldn't take that deal. Who is willing to pay a high deductible? Only someone who doesn't plan on getting sick. The struggle was messy. It turned buying insurance from a simple handshake into a bureaucratic nightmare of forms, checks, and balances. But it worked. By forcing customers to reveal their private information through their actions, not their words, the market began to stabilize. The fog of secrecy was lifting, but the cost was high. The era of simple trust was over. The era of prove it had begun. The result of this painful evolution was nothing short of a miracle. Once insurance companies learned how to filter out the lemons, the secretly sick, and identify the peaches, the healthy, the death spiral stopped. Costs stabilized. Premiums dropped drastically. Suddenly, life insurance wasn't just a gamble for the dying. It became a cornerstone of financial planning for the middle class. By the early 20th century, the industry had grown from a fragile experiment into a titan of the global economy, holding assets worth billions. Look at the difference. In the blind market of the 1850s, a policy was a rare, expensive luxury fraught with fraud. In the screened market of today, you can buy a policy on your phone in 10 minutes. Why? Because the flow of information is now managed. The Nobel Committee recognized Akerlof, Spence, and Stiglitz in 2001 not just for pointing out the problem, but for explaining the solution. They showed that information symmetry is not a natural state of nature. It is something we have to build, fight for, and design into our institutions. However, this victory came with a twist. To save the free market, we had to make it less free. We added background checks, credit scores, and regulations. We sacrificed privacy for stability. And just when we thought we had mastered the beast of asymmetric information, the 21st century arrived with a new, much more dangerous monster. But there is a dark side to fixing the information gap. Michael Spence, one of our laureates, warned us about this. He called it the cost of signaling. Let's look at the university degree. In an ideal world, you go to college to learn skills that make you productive. That is human capital. But Spence proposed a more cynical theory. What if college doesn't actually teach you much? What if its main purpose is just to be a very expensive, very difficult obstacle course? To an employer, a degree is a signal. It tells them, hey, I am smart enough to get in and obedient enough to finish. It separates the high-quality workers from the low-quality ones. It solves the information problem for the boss. But here's the trap. If everyone gets a bachelor's degree to send that signal, the signal loses its value. It becomes noise. So to stand out, the good workers now need a master's degree, then a PhD. We enter an arms race of credentials. We spend years and billions of dollars not to become more productive, but simply to scream, "Pick me," louder than the person next to us. This is the dangerous implication of the 2001 Nobel Prize. Efforts to reveal the truth can sometimes burn down the entire village. We are spending more resources than ever just to filter information, creating a society that is over-credentialed, underemployed, and drowning in debt. And if you think wasted tuition is bad, wait until you see what happens when the signals themselves are fake. That is how you get a global financial collapse. If you want to see what happens when signaling and screening fail simultaneously, look at the 2008 global financial crisis. It was, in essence, Akerlof's lemon problem on a thermonuclear scale. Wall Street bankers took millions of toxic mortgages, the lemons, loans given to people who could never pay them back. But instead of throwing them away, they packaged them into complex bundles. Then they paid the rating agencies to stamp them AAA. That AAA stamp was the signal. Investors trusted it. They bought these bundles thinking they were buying peaches. They thought they were buying safety. But the signal was a lie. The sellers knew the truth. The buyers were blind. When the truth finally revealed itself, the entire global market evaporated overnight. But today, in 2025, we face a new asymmetry that makes 2008 look simple. We are entering the era of artificial asymmetry. With the rise of generative AI and deepfakes, the cost of truth has skyrocketed. When you see a video on social media, you don't know if it's real. When you read an email, you don't know if a human wrote it. The lemons, fake content, are now indistinguishable from the peaches, reality. This affects your wallet directly. Why are scams increasing? Why is hiring getting harder? Why is political polarization tearing countries apart? Because, just like the used car buyers in 1970, we are starting to assume everything is fake. We are withdrawing our trust. And as Akerlof taught us, when trust vanishes, the market doesn't just slow down. It stops. We are no longer just worried about buying a bad car. We are worried about buying a fake reality. In the end, the 2001 Nobel Prize wasn't really about used cars, or insurance policies, or university degrees. It was an admission of humility. For centuries, economists tried to treat the world like a physics equation. They wanted to believe that if we just let the invisible hand do its work, everything would balance out perfectly. But George Akerlof, Michael Spence, and Joseph Stiglitz reminded us of a messy, uncomfortable truth. The invisible hand is attached to a human arm, and humans are complicated. We lie, we hide, we bluff, we keep secrets. Their work taught us that the free market is not a magical machine that runs on autopilot. It is a fragile garden that needs constant tending. It requires institutions, laws, regulations, warranties, and certifications to bridge the gap of silence between the buyer and the seller. In a world drowning in data but starving for truth, their lesson is more urgent than ever. Information is not just power, it is the very oxygen of the economy. Cut off the flow of truth, and the market suffocates. So the next time you check a seller's rating, look at a diploma on a wall, or read a food label, remember the 3 men who won a gold medal for proving a simple fact. Trust is the most expensive currency in the world, and once it's broken, no amount of money can buy it back. This video was a deep dive into one of the most complex topics in economic history, and the fact that you are still here proves that you value high-quality information. You are definitely a peach, not a lemon. If you enjoyed this analysis, please consider signaling your support by liking and subscribing. It helps us overcome the YouTube algorithm's asymmetric information problem and get these stories to more people. Thank you for watching Economic Comment, and I'll see you in the next one.